Welcome to the Deep Dive, where we cut through the noise to bring you the most critical insights.
That's the goal.
Today, we're taking a deep dive into Frontier Group Holdings, ticker ULCC, ultra low-cost carrier.
Yeah.
We're digging into their second quarter 2025 earnings call. And it looked pretty rough initially.
It really did.
But surprisingly, it unfolded into this fascinating story, navigating some serious turbulence, making bold strategic pivots.
And that market reaction afterwards, quite something.
Exactly. A big rebound few saw coming. So our mission today is to give you the clearest picture of what's actually driving Frontier right now.
Right. Because those headline Q2 numbers, they definitely spooked the market at first.
For sure.
But the management commentary, what they said, and how the stock recovered since, it paints a much more, let's say, nuanced picture.
Okay.
We're going to unpack what Frontier is doing to fix its yields, basically, how much cash they make per flyer, and how they're setting themselves up for what they see as a huge shift coming in the domestic airline world.
All right, let's get into that initial turbulence then. The numbers. Frontier reported a GAAP EPS, that's earnings per share, of -$0.31.
Or missed the consensus, right?
Yeah, missed the FactSet consensus by $0.03. So slightly bigger loss than analysts expected.
Okay.
Revenue landed at $929 million. That was about 1.4% below estimates. And it marked a noticeable decline year over year, about 4.5% to 5% down.
Not great on the surface.
No. And they posted a net loss of $70 million for the quarter. Compare that to a profit in Q2 last year.
Yeah.
It's a pretty stark contrast, wouldn't you say?
Absolutely. A tough quarter on paper. And those figures, they hit the stock immediately.
Right.
Shares dropped around 9% after the release. Even pre-market, it was down nearly 14% that day.
Wow.
But here's where it gets really interesting for you listening in. The stock since then, a massive turnaround.
It really bounced back.
We're talking a 1-month return of 55%. 55.
And
And 3-month return of 32%.
that's way ahead of the rest of the sector.
Miles ahead. The broader airline sector's been kind of flat. So this tells you that despite the rough Q2 numbers, something in the management story, their strategy, it really clicked with investors.
Okay, so it's not just the numbers, it's the narrative.
Exactly. The narrative carried a lot of weight here.
So if the initial numbers were that challenging, what exactly were the headwinds? Operationally, financially.
Oh, let's dig into that.
The details show RSM revenue per available seat mile was 9.01 cents. Meanwhile, CASM, the cost per available seat mile, actually went up 8% year over year to 9.73 cents.
Which is the wrong direction for costs.
Right. And maybe more critically, CASM ex fuel. Stripping out the volatile fuel costs to see the core operational costs. That hit 7.50 cents.
Oof.
Management pointed fingers, partly, at things outside their control, like significant weather issues, widespread air traffic control ATC delays, especially a late May, June.
Always a factor in summer.
They figured these external things had maybe a 2 to 3 point negative hit on the quarter, but were there internal factors too? Was it all ATC and weather?
That's a really good question, because no, the rise in TCASM ex fuel wasn't just external. A big chunk of it came from a deliberate choice.
Oh.
They cut their average daily aircraft utilization by 13%. Think of it like running your factory fewer hours each day, on purpose.
Okay, so flying each plane less. Why?
It was a direct result of their push for capacity discipline. They were intentionally flying less, especially on weaker demand days, to align with where they thought they could actually make money.
Not just chasing passengers at any cost.
Exactly. It's a tough trade-off, right? You hurt your short-term efficiency metrics like CASM, but the goal is better profit per flight.
Makes sense. A strategic gamble then.
Sort of, but they do have a cushion. On the plus side, their liquidity at the end of Q2 was solid. $766 million total, with $561 million in cash.
So a decent runway.
Yeah, gives them breathing room for these strategic shifts. And they're still modernizing the fleet, which is crucial long-term. Took delivery of 3 new A321neos, returned 2 older A320ceos.
Getting more fuel efficient.
Right. Now, 84% of their fleet is the A320neo family. That's key for keeping costs down eventually.
Okay, so this is where we see those strategic pivots starting to emerge, the things that maybe caught the market's eye.
I think so.
Management really hammered this shift towards, what do they call it, peak day flying.
Yeah, focusing flying on the busiest days.
And deliberately scaling back the off-peak schedules. It sounds like a direct reaction to this tough domestic environment.
It absolutely is.
They're leaning hard into capacity discipline, especially, like you said, on slower days, maybe Tuesdays, Wednesdays, all to fix those yields.
Repairing yields is the mantra.
But is it just about flying less? Or is there more to this strategy?
Oh, it's definitely more. And this part is, I think, really pivotal for their whole long-term story. They're investing heavily in premiumization and loyalty.
Premiumization at an ultra-low-cost carrier.
Interesting.
It sounds counterintuitive, but look at the numbers. Their co-brand loyalty revenue per passenger surged over 40% year over year in Q2.
Wow, 40%. Yeah, and cardholder spend was up nearly 20%. These aren't small changes. It shows that part of the strategy is getting traction.
Okay, so loyalty is becoming a real revenue driver.
And they have big goals for it. They're targeting $6 per passenger from loyalty by the end of 2026. And then, get this, $10 per passenger by the end of 2028.
Ambitious. How are they planning to get there?
Well, they're rolling out a bunch of stuff. New status match programs to lure frequent flyers, companion pass deals.
Yeah.
They're putting first-class seating across the whole fleet by next spring, expanding those upfront pluses, extra legroom rows, too.
So giving people more options to pay for upgrades.
Exactly. More ways to spend a bit more for a better experience, which means higher revenue for Frontier.
And what about the tech side?
Yeah.
The digital strategy to back this up?
Yeah, that's a key piece, too. They launched new mobile apps.
Right.
And they're speeding up their NDC transition.
NDC, new distribution capability.
Right. It's basically tech that lets airlines sell directly, bypass some older systems, offer more personalized bundles and deals, cuts out middleman costs sometimes, too.
Makes sense.
They're partnering with big names like Amadeus, Fareportal, Hopper. The idea is to manage revenue better in real time, offer tailored deals. It's this whole package designed to boost revenue quality, less reliance on just those super low base fare.
Right, get more value from each seat sold.
Precisely. Not just packing planes, but getting more dollars per passenger.
Okay, quite the strategic overhaul happening there. Let's look ahead then. After weathering Q2 and making these pivots, what's the forecast?
Cautious optimism, I'd say.
Their Q3 guidance projects an adjusted EPS loss, still a loss, between -$0.26 and -$0.42.
So still losing money, but maybe less.
Potentially. They do expect RAS growth mid to high single digits, which is good. But capacity is still expected to be down year over year, about 3% to 5%.
Yeah, continuing that discipline.
Yep. And Q4 capacity looks relatively flat year over year. But that Q3 guidance range, -$0.26 to -$0.42, that's quite wide, isn't it?
It is noticeably wide. And management basically said, look, we've been burned in the last 6 months by how fast consumer sentiment can swing. They feel like they're in a month-to-month consumer sentiment game. Demand can just, dry up or surge based on news or economic feelings.
So hedging their bets a bit with the wide range.
Pretty much. But interestingly, despite a tough start to Q3 in July, they said sales trends from mid-July onwards showed big jumps.
Oh, really? A rebound within the quarter.
Seems like it. They reported double-digit year-over-year sales growth for all future periods, even with less capacity on sale.
That's significant.
And here's the key part. August yields were up 5%, and September forward yields looked up an impressive 15%.
15%? Wow.
Yeah. So that strong rebound in future bookings seems driven more by yield higher prices rather than just filling more seats, which suggests maybe that capacity discipline is finally starting to bite and pay off for Q3 and Q4.
Okay, so the strategy might actually be working as planned, despite the continued loss forecast for Q3.
The early signs are pointing that way, potentially.
Which brings us to the wider industry context. Frontier's CEO, Barry Biffle, he made a pretty punchy statement on the call.
He usually does.
He basically asserted that, quote, everyone right now is losing money domestically if you ignore international flying and codeshare benefits.
Wow. That's blunt.
Yeah. He believes there's just way too much supply chasing, too little demand in the U.S. domestic market, driving those base fares down to unsustainable levels.
Like that $29 fare example.
Exactly. Where he said the airline only gets $15 after taxes and fees. That's a really stark view of the U.S. market right now.
It's a huge statement, and if you connect that to the bigger picture, really implies the whole domestic airline scene is set for a major shakeup, a rebalancing.
Seems inevitable if everyone's losing money.
Right. And what's interesting for Frontier specifically is they noted seeing more competitive capacity coming out of their core markets, about 3 points more than the industry average reduction.
So competitors are pulling back more where Frontier flies.
Seems so. And there were hints about a certain carrier. People assume that means Spirit retreating from routes they both flew, which naturally sparks hope for Frontier to grab some market share.
The last man standing idea.
Exactly. Frontier genuinely seems to believe it will be the last man standing in the low-cost space by next year because they have the lowest cost structure, supposedly, and one of the cleaner balance sheets.
This is a bold claim.
It is. And it's kind of counter to the traditional ULCC model, which is usually all about rapid growth, right?
Yeah, add planes, add routes.
But Frontier's positioning itself differently now. They want to be the main beneficiary when, not if, industry capacity shrinks and maybe consolidation happens.
So their future growth isn't just about adding flights everywhere.
Apparently not. It's expected more on those peak days of the week or peak periods of the year, leveraging the planes and pilots they already have, but only when demand justifies it, not just flying empty seats midweek.
Like you said, 79 is the new 49.
And 99 is the new 79.
Yeah.
Believing prices just have to go up across the board for the industry to be healthy.
Okay, so Frontier sees itself as the leanest competitor, ready to thrive when the market finally corrects itself.
That seems to be the core message.
All right. Given this whole strategic map they're laying out, the industry view, it definitely gets you thinking about what ifs, which brings us perfectly to our not financial advice segment,
Let's do it.
where we throw out a bold, maybe outrageous, but plausible trade idea based on what we've just discussed. Purely hypothetical, of course.
Of course. So given Frontier's whole narrative, right, the strategic pivot, the last man standing talk, the CEO saying everyone else is bleeding cash domestically,
Yeah.
here's a thought. What about looking at, say, a long-dated, out-of-the-money call option spread on ULCC for 2026, perhaps?
Okay, so a bullish bet on Frontier, but further out.
Exactly. It pays off big if the stock really moves up significantly by then. And you could combine that with maybe a short position in a competitor.
Shorting another airline. Which kind?
Maybe one known for having, a less fuel-efficient older fleet and maybe carrying more debt.
Targeting a weaker player.
The idea is you're playing for that industry consolidation and fleet modernization to accelerate, just like Bivol seems to expect in 2026. If that dawn really comes for Frontier as the industry right-sizes,
Then their low cost and modern planes could win out.
potentially delivering outsized returns while others struggle or get bought out,
Yeah.
it's not just a bet on Frontier turning around, it's a bigger speculative bet on that whole domestic market structure shift, the strong surviving.
Fascinating idea. And definitely not financial advice.
Definitely not. Purely a thought experiment for you, the listener.
Okay, so wrapping this up. Q2 was clearly bumpy for Frontier, no doubt about it.
A rough patch for sure.
But management is steering the ship with a very clear strategy now. Capacity discipline, focusing on loyalty, adding those premium options.
A defined playbook?
And that initial market panic after the results, it's completely flipped. The strong performance suggests investors, well, they might be buying into this long-term vision.
They seem to be betting on sustained yield improvements, that loyalty push gaining more steam, and maybe Frontier benefiting as the competitive landscape reshapes.
A leaner, maybe more profitable ULCC emerging from the turbulence.
That's the hope. The key takeaway here for you is really Frontier's conviction. They firmly believe the domestic market is facing major change, maybe painful change.
And they're positioning themselves now.
Proactively,
Yeah.
making calculated short-term sacrifices like lower utilization, higher CSM temporarily, for what they hope is durable profit down the road, especially looking out to 2026.
So the challenge for observers.
Is to watch closely. Can this pivot, this focus on selective flying and premium extras, actually deliver the sustained profitability they're aiming for? Especially as the whole industry goes through this rebalancing. It's going to be fascinating to track.
Absolutely. Well, that's all for this deep dive into Frontier Group Holdings. We hope this gave you a useful shortcut to understanding the dynamics at play.
Lots happening in the airline space.
For sure. We encourage you to keep watching how these strategies unfold. Thanks for joining us on the deep dive.